In this video, we will be covering Chapter 3 in your reimbursement textbook. This chapter deals with commercial healthcare insurance, and basically commercial insurance is the non-government insurance, so not Medicare, not Medicaid. And the way commercial insurance is obtained is two ways: individual or employer based. Individual is coverage that an individual or a family purchases on their own that is not related to employment or based on employment. So this may be someone self-employed, farmers, someone that doesn't have insurance through their job and doesn't qualify for any government type insurance. Employer-based insurance is just as it sounds. That's coverage, could be for an individual or the whole family, that is part of the employment benefit package. So it's insurance that is tied to your employment. Payments from commercial insurance, both of these types here, equates to about 33% of healthcare expenditures in the United States. So it is important that we understand both of these types of insurance that we'll be covering in this chapter, and also some just basic healthcare or reimbursement terminology we will be covering in this PowerPoint in this chapter as well. Before the 1970s, though, all voluntary health insurance was called indemnity health insurance, and that was where individuals had the freedom to choose their healthcare professionals. And in the current healthcare arena, commercial health insurance plans include indemnity, but they also include managed care plans, and that we'll discuss in Chapter 5, much more on managed care and HMOs. So either type of commercial health insurance, the individual or the employer, generally the person taking out the insurance or the plan offers a single coverage or a family coverage. So single is just as it sounds. It's for yourself only. It's an individual plan. Family could include a spouse, children, even adult children up to the age of 26. Disabled persons could also fall under those dependents. So dependents are spouses or other family members that are on that plan. Obviously, if any of you have had employer-based or individual health insurance plan, you know that family coverage is much more expensive than single. And generally, if you have children on your plan, or if you are an older person, your premium or what you pay per month will be more because the likelihood of you using that insurance more is greater. No matter what type of insurance that you have, you fall into a risk pool. And that is basically the group of individuals, employers, associations, whatever group that is. If it's part of a group, you are grouped, lumped into one pool. And the hope is that some individuals in that group will not use the services or cost as much to that insurance as others. So the goal is, because insurance companies are businesses, that they need to make money in order to stay in business and pay their employees, that they need to make some money. So the hope is that the risk pool evens out. Not everyone will have a catastrophic event, cancer, car accident, that you have severe injuries, that type of thing. There are three types of risk pools that we'll talk about in this chapter. Individual, those relate to those individual health insurance plan. These are the self-employed people or people that work for companies that don't offer health insurance. These people are similar because they're all seeking health insurance. So because you're not essentially in a group, like an employment group, your risk is a little bit higher. So if anyone has had individual health insurance, you're in an individual pool. Generally, because there's not as many people, it's not as diverse, it will cost you more. A large employer pool, those are for an employer typically with over 1,000 members. So in that pool, it's very large, so more than likely it's very diverse. Some people are very healthy and hopefully just a few sick. The last is multiple employer pool. This is composed of employees from several mid-size or small employers that are grouped into one. Those pools obviously are smaller than a large employer, so less diverse. All right, so this slide is some basic insurance terms that really apply to almost all types of insurance benefits. So the first one is benefits. That generally you may hear it called covered services. This is basically what the insurance plan has outlined that they will cover. Maybe they will cover certain types of surgeries. Maybe they will not cover a visit to the emergency room, that type of thing. So, what are we going to cover and what are we not? These will be outlined in the insurance documents. The policyholder, or another term for that, is the insured. So, this is the individual or the entity that purchases the insurance policy or the insurance contract. You also may hear subscriber. That may be a term that you hear. Premiums, this is the payments that a policyholder must make to an insurer in return for healthcare coverage. Generally, it's monthly, but depending upon your policy, it may be every paycheck. It may be less frequent than every month. So it really just depends on the insurance plan. Another term that's not on this slide here is deductible. That's the yearly amount that the policyholder or the subscriber has to pay before the insurance company will start to pay. Cost sharing provisions, those we're going to talk about a little bit later in the chapter, but those are just parts of the policy that require the insured to pay for a portion of their healthcare insurance that relates to the deductible, but there's some other things that we'll talk about in a little bit. To date, there are 35 states that have a state healthcare insurance plan. The purpose of those is to provide access to health insurance coverage to the medically uninsurable. So those are state healthcare plans that are often called high risk pools. These are people that have been deemed medically uninsurable because of a pre-existing or a chronic disease, or maybe even both of those. As part of any insurance policy, you will be given provisions of that plan. The health insurance policy, that's a formal contract between the health insurance company and the individual or the group. So this contract is called a certificate of insurance. And basically, this certificate of insurance outlines all the covered conditions. Covered conditions are the health conditions, illnesses, diseases that the health insurance company will pay for treatment. The policy will also outline things that they do not cover as part of their plan. Healthcare insurance policies are divided into sections, And the main ones are on this slide: definitions, eligibility and enrollment, benefits. In your textbook on page 59, there is an example 3.1 of definitions that you may find in your insurance policy. All of these three things listed on this slide will vary between policy. So what's a definition in one policy may not be in another, or what's covered in one policy may not be covered in another. The eligibility section of the policy that specifies the individuals who are eligible to apply for insurance. The enrollment section specifies the procedures to obtain insurance. Also in that section, the group, it may outline if they require a waiting period. So waiting period is how long before benefits kick in. The waiting period, it's the period that has to pass before coverage to employees or independents who are eligible to enroll under the terms of that plan. The waiting period cannot exceed 90 days. And benefits are just as it sounds. Those are the healthcare services that the insurance company will pay for. One term in there to note is stop loss benefit. That's a specific amount in a certain time frame, such as a year, beyond which all covered healthcare services for that policyholder or the dependents are paid at 100%. That benefit is known as maximum out-of-pocket cost. So you'll have a deductible that you have to pay per year. Say that deductible's $3,000, but then the insurance plan may have a stop loss benefit of $5,000 or $10,000. It really varies, and you will not have to pay more out of your pocket than that set amount. Limitations, those are the qualifications that limit the extent of benefits. Limitations can be put on a total dollar amount, a time frame, duration, or a number. So for example, purchases of durable medical equipment that exceed $500 require prior approval from the insurance company. That's just an example of one. Common limitations are the cost-sharing provisions. On many policies, the extent and number of cost-sharing provisions have risen as the cost of healthcare insurance has increased. Cost-sharing provisions, they require policyholders to bear some of the costs of the healthcare that they consume. So the types of cost-sharing provisions are listed on this slide. Coinsurance, that's the pre-established percent of eligible expenses after the deductible has been met. So that percent can vary by type of service or site of service. So for example, you may have to pay 20% on durable medical equipment, but maybe you have to pay 50% of an ER visit. Copayment, that is a fixed dollar amount or a flat fee that varies by type of service. For example, most plans have an office visit copay. So for example, you have to pay $20 for a clinic visit. That's a set amount. It doesn't change no matter how many clinic visits you have in a time period. Some healthcare plans have tiers. Basically, a tier is just a level of coverage or a limit of coverage. So you may have to pay more if you go out of network versus in network. And there, if the insurance plan has tiers or limits, they will vary from plan to plan and based on what that insurance company has developed to be their tiers. And some more parts of your insurance policy. I'm sure all of you have read your insurance policies from front to back. More than likely not. But these are all that we've talked about, and this is more that will be in there. Again, it is not the same between any policies. So appeals, this is a process of reconsideration. So if your claim is denied, what are the steps to appeal it? Is there a time frame that you can appeal it? That will be listed in your insurance policy. Exclusions, those are instances or maybe conditions or injuries that the healthcare plan states they will not cover. They will not pay any benefits. Generally, that's experimental or cosmetic type procedures. A rider, that's a document that's added to a policy that provides details about coverage or lack of coverage in specific situations. An endorsement, that's language or a statement in your policy that adds information about coverage or lack of coverage. So riders and endorsements, those are similar to limitations and exclusions. They just provide more details about what's covered and what's not covered for special situations. This part of the insurance policy is procedures. These are things, part of the policies that explain how you as the policyholder can qualify to receive healthcare benefits or special things you need to do. So prior approval, prior authorization, you may need to get an okay from your insurance company before you have a specific type of procedure, an MRI, or before you enroll in physical therapy. Again, this is all very dependent upon your insurance plan. Coordination of benefits. That is a procedure that's used when multiple insurance companies are involved. So that becomes necessary when people have multiple insurance plans. So we have a husband and wife and both have insurance, or if you have maybe an individual policy and you have Medicare, it depends on which policies you have in place. So they coordinate among themselves. The primary insurer is the insurance company that's responsible for the greatest or the majority of the expenses. The secondary is then responsible for the remainder. There are some rules when determining which policies first, which policy pays second. So the patient's health insurance is primary over a spouse. So I'm married. If my husband and I both carry an insurance plan and I visit the doctor, my insurance company will pay first as primary, and my husband's will pay secondary, or basically what's left over. If there is a dependent child that comes into play, so say I have an insurance policy, my husband has an insurance policy, we have 2 children. What happens when they visit the doctor? That is where the birthday rule comes into play. And this is if my sons go to the doctor and the primary payer will be whose birthday comes first in the calendar year. And it's not based on year, it's based on day and month. So if I was born January 1st, my husband was born January 2nd, my policy would pay first. So it's day, month, whoever comes first is the primary payer for the dependents. Other party liability, that's used when multiple insurers are involved in a healthy and non-healthy situation. So for example, if you're involved in a motor vehicle accident, or if you have an injury that happened on another person's property. So as you can see in the policy things we talked about, Really, it's like a puzzle. They all work together to outline your coverage. A lot of it may look like foreign language to someone that is not familiar with healthcare terminology. So hopefully this will help you understand your own insurance policy better as well. This is the example of an insurance card that is in your textbook. So if you would go through and read each of those elements, especially if anything's unclear, maybe the member responsibility part, but that's all detailed very thoroughly in your textbook, each of these items. So make sure and go through and read that as part of your textbook reading. So this is the part of the chapter that really will apply to all the rest of the class, applies to all your coding classes, and this is when we submit a claim to the insurance company in order to get payment. How we get payment comes from code numbers. As all of you know from taking your coding classes, those coding numbers are a universal system that gets submitted to insurance companies, and then they determine if it was a covered service, a not covered service, and all those other limitations and things outlined in the insurance policy. In 2012, a part of HIPAA specified all healthcare providers have to use electronic claims submission, or ECS, to submit claims to Medicare. So electronic formats correspond to paper formats, the UB04 and the CMS 1500. I have included some links for you in the module. You can go through and see a sample of each of those forms and get very detailed descriptions on both of those. Most healthcare facilities will have a system in place called a scrubber that will look at claims and look for errors, because we want clean claims. That is a claim that's filed with the insurance company that is free of errors and processed in a timely manner. It may not be a coding error. It may be a completely different error, maybe one that's related to registration. So hopefully the goal is to catch all claims with errors before they leave your facility. If they don't and they get to the insurance company, they're a dirty claim. Basically, that's missing information, some information is inaccurate. That claim is going to be delayed significantly, which will cost your facility money. Adjudication, that is the determination of reimbursement payment based on your insurance benefits. When claims submitted are clean, auto adjudication can occur, and that's basically when computer software processes the claim automatically. No person has to go in and approve or deny that claim. So once a claim is paid and reimbursement is sent electronically to the provider's bank through the electronic funds transfer, or ETF, the payment will include a remittance advice, or an RA. This is sent to the provider. The exact same thing we'll talk about on the next slide, essentially, is the EOB, or the explanation of benefits. And that is, like I said, essentially the same document, but it goes to the patient. Both the RA and the EOB are reports that show what was paid and what was not paid for the healthcare services. It lists any rejections, any denials. Was there adjustments? Maybe you're part of a PPO that if you go to a certain provider, you only have to pay a specific dollar amount. Those types of things would all be listed on there. And again, the EOB, essentially it contains the same information, but it's going to the patient. All of you have gotten an EOB if you have been covered under an insurance plan. On page 72 of your book, figure 3.4, there is a sample EOB. You can review that, and also in your textbook reading, there is some very detailed definitions of all those items on that figure. As we all are very aware, and we talked about in chapter 1 a little bit, the cost of healthcare in the US continues to rise very rapidly. 5 factors have been deemed accountable for this increase. 1 is economy-wide inflation, 2 is medical inflation, 3 is the population change, 4 is the shift in age and sex mix of our population, and 5 is other non-price factors such as greater utilization of services and intensity of services. All of this has effects on us as consumers, the providers, and also on our health insurance plans. Consumer-directed health insurance plans, or CDHP, those are a form of health insurance that are really designed to reduce healthcare cost by providing subscribers with some sort of financial incentive to choose a lower priced option for their healthcare benefits. These are generally known as high deductible plans or even a health savings account. Some of those I'm sure you have heard of, but the intent is for you as the patient or the subscriber to make better decisions on when you will visit the doctor instead of the thought that I know it's paid for, so I'm going to go to the emergency room, maybe unnecessarily. Maybe it could wait for an office visit the next day. All of those are to get the patient to think more about how they use healthcare services. That could have a negative impact, and maybe you as the patient do not see the provider when you need to because your deductible is so high. So there's that piece of the puzzle too. There is also value-based insurance design, and that was mandated under Section 2713 of the ACA. So I think we'll see more of these, the value-based, and looking at actual outcomes of the patients in the future. And also the last part that your chapter talks about is wellness programs. I know when I was employed with a large healthcare system, that every year when our insurance was up, to renew, or you could change things about it, there was an incentive that you got a discount on your insurance for every wellness item that you met. So, for example, one was if you had a healthy range BMI, body mass index, you got a specific discount. The next item was if you were a non-smoker, you got a discount, and that needed to be proved by a lung test, not just you saying I'm not a smoker. Another was if you had healthy blood pressure and cholesterol. So I think that's something that more and more companies will move to try and move to these wellness programs and try to get their risk pools to be healthier, to cost less insurance money.